Good morning, everyone, and welcome to the BetaShares quarterly economic and investment update webinar. Will Delta derail the equity rebound? I think it's a question on a lot of investors' minds. So thank you all for jumping on today, and hopefully our key speaker, David Bassanese, should give you some insight around that. So we'll get started. And just a quick bit of admin to get out the way before we jump into today's webinar and the all-important disclaimer slide. I'll just get everyone to take a read of this, please, and just highlighting there, of course, that past performance is not indicative of future performance, and also just noting that any advice today is very much general in nature, and we won't be taking into account anyone's personal circumstances. Also, the webinar will be recorded, so you will receive a copy of this shortly after it is finished. So if you do need to pop away and grab a cup of tea or do something, don't worry, you'll be able to go back and cover off anything that you may have missed there. And please do write through some questions for us. I know we've received a stack of questions prior to this webinar, so there's a lot of questions for David to cover at the end, but please do write some additional ones as we go through the presentation and webinar today. So just using that widget box on the right hand side there. And something we really do pride ourselves on, being an Australian founded ETF fund manager, is providing our investors with all the insights and supports they need to make informed investment decisions. So if you do need any insights in terms of regular updates on markets, please do jump on and sign up for our insights, which David's Bassanese Bites comes out on every Monday, along with a lot of other information around funds, investment themes, trends reports and blogs from our distribution team as well. And of course, on our website, you'll find all those relevant fact sheets and information on performance of some of the funds as well. So do use that as a resource. And of course, to keep across all of that, do follow our social media pages and our Twitter, LinkedIn, Facebook, and there's some really great content and video on YouTube as well. A bit of an update from BetaShares. BetaShares, we are a leading ETF fund manager, and hopefully a lot of the people attending today are already BetaShares investors. And thank you very much for your support and taking the time to review and select our funds over the 10.5 years we've been in the Australian market. Being that we are an Australian founded ETF fund manager, we really do place that high value on providing as much support and access to global markets and domestic markets through our ETF strategies, from low-cost ASX 200 exposures at 7 basis points to some of those more exciting global thematics and growth areas. And I know David today will be covering a few of those ways that you can use our ETFs to implement your view on future markets. And with that, we have have 63 different ETFs that you can access through the ASX, and we now manage almost 20 billion actually. So we're very close to tipping over that milestone. So again, thank you all who are on this webinar today for your support. And our key speaker being David Bassanese, our Chief Economist here at BetaShares. So David is responsible at BetaShares for developing economic insights and portfolio construction strategies for our institutional advisor and retail investors. He's also the chair of our investment committee, which that plays a big part in those ASX listed diversified funds that you can access through one simple trade as well. Formerly, David was a columnist at the AFR, so you probably read some of his content in the past. He was also a senior economist and interest rate strategist at Bankers Trust and Macquarie Bank, Treasury and OECD economist. And for all those interested in learning more about ETFs and investing, he also has a comprehensive ebook, the Australian ETF Guide. So thank you so much, David, for joining us today and for sharing us your insights. So we're going to pop up a quick poll right now, just before we go into the agenda there. So if I can get everyone just to click on what they believe is the biggest near-term risk to the markets. Do you think it's inflation? Do you think that the effects of COVID is the biggest risk to the market? Or are you in the belief that the tension between China and US will derail that global market? I'll get everyone another 5 seconds just to click on that. So we'll share the results of that now. Oh wait, we'll go to the next question first. So the next question being, what are you predominantly seeking from the market? Is that long-term capital growth? Are you looking for a regular source of income, which is a key concern for a lot of Australian investors, diversification, or all of the above? So looking at the poll results coming in, we've got regular source of income leading so far, with long-term capital growth in a close second. So we'll close that off. So it ended up actually, so the first poll question is the biggest concern was around COVID, with a very close second in terms of China tensions and inflation. So inflation being the second biggest risk, and then China. And we'll see the answers for the second poll question as well. And we can actually see that long-term capital growth is one of the key areas that investors are currently looking at. And obviously that's second part there, or actually, sorry, my box was covering it. Looks like all of the above is actually sort of first equal. So long-term growth and all of the above with regular source of income. So thank you all for sharing your insights on that. So today, in terms of the agenda, the first thing David will be covering is an update on COVID and having a look at some of those numbers in terms of infection rates and the effects of those. He will then be sharing his view on the economic outlook, both domestically and internationally, with that market outlook. And then finally, looking at some investment themes based on either cyclical growth or inflationary views that you as an investor might have, how you can actually invest to benefit from those views within your portfolio with some of our ETFs. So with that, David, I'll pass it over to you, and I'll pop back on in the end to cover off some of those questions that come through.
No worries. Thanks very much, Chris, and great to be with you all today for the latest quarterly update. Yeah, so as Chris mentioned, going to break it up. I'm going to talk for about half an hour. There's a lot to get through, so I may skip over a few little elements, but they will all obviously be in the chart book and leave plenty of time for questions. So I will, obviously, COVID is first and foremost in terms of investor concerns at the moment. So I'll give you my take on COVID at the moment, an update on the economic outlook, the market outlook, and then dive into some investment themes at the end of the presentation. Now, firstly, just with COVID, I mean, as we're seeing, I mean, it's all about it's not it is a race. Let's be clear about this. It is now a race, and we are losing that race. So if you look at the vaccine rollout in the US and the UK, they had basically a 3-month head start on us. Their regulatory authorities, approved the vaccines a lot quicker than ours did. We were more cautious. And, at the end of the day, I think what's happened here is we got incredibly complacent by having dealt with COVID so well last year, having very low case count. So we were relaxed in, choosing vaccines, approving vaccines, ordering vaccines, and now we've been hit by the Delta variant, and we're sort of, slowly trying to catch up with the rest. Now, the good news for markets is that the US and Europe, as you can see there, more than half of the population are fully vaccinated. Australia bringing up the rear, around about just under 20% now fully vaccinated in Australia. But we're probably going to get, and judging by the US and the UK, it's going to take at least a few months before we get up to the 50 to 70% area. But the implication of what we're seeing with the vaccines around the world is that if you look at the UK in particular, they had a significant third wave of cases just recently. But if you look at things like hospitalisation, I've got death rates there. The spike in that was nowhere near what we saw in previous waves. Similarly with the US, I mean, they've had a spike, but the death rate, hospitalisation rates are a lot lower. So that's allowed them to basically keep their economies open. In the case of the UK, opening up, reopening, because of the effect of the vaccines. Now, in the case of the UK, I mean, they were opening up where on a per capita basis, they were still getting, on a per capita basis in Australian terms, it was like still getting something like 20 deaths a day, but they still opened up. So, the challenge for us is, what level of deaths, even with full vaccination, you know, we are going to open up, and I think, you know, more and more people are, you know, realizing, you know, Delta and other potential variants, it's going to be impossible to basically have a zero strategy here. But once everyone's vaccinated, then really it's those that are left unvaccinated that are most at risk. And so, you know, if you choose to be unvaccinated, you know, for whatever reason, that's the risk on you. But the rest of the economy is going to move ahead and open up. But just to you know, the key issue here is that globally, vaccinations are rolling out. The US and Europe have been, you know, particularly the UK, successful in doing it, and it is meaning that economies can open up. And so, you know, to answer that question of the webinar, yes, I don't think Delta will derail the global equity recovery. And even our market, as you can see, we're shrugging off Delta at the moment, the market touching new record highs, because we think it's going to be a temporary jolt to growth, albeit, you know, a few months. But probably even more importantly is that the rest of the world, at least, is dealing with it, and global markets are moving higher, which is helping, you know, drag our market up at the moment. So that's the Australian situation. As I said, we're now going through our third wave in terms of cases, particularly in New South Wales. Look, by previous standards, the death rate is still a bit lower. I mean, the good news here is that many elderly people, or the most vulnerable, are now vaccinated, at least. Well, many of them are, not everybody, of course, but the bigger chunk of the population that is vaccinated are the more vulnerable, older members of the community, which is good news. But you know, at the moment we're still in lockdown, and it looks like we're going to be there for a while longer until we get that vaccination rate up at least to 50 or so percent. Just a few other things I thought I'd share with you in terms of COVID. I mean, I put out a blog a few weeks ago. I mean, people deride, you know, what we did tackle COVID pretty well last year. There's that on again, off again debate about, are the lockdowns too hard? Should we have done it? You know, should we have live with the virus, so to speak? This just shows you what happened globally through much of last year and this year, where something like 4 to 10% of the population did get COVID, and of that, around about 2% of those that did get COVID, according to the official data, did die. Now, so if you apply the same sort of numbering in Australia, I mean, in Australia's case, only like 0.12% of the population got COVID, so much lower. And we did have you know, of those, the percent that did, the mortality rate was a bit higher nonetheless. But this is the important number, the 0.12%. If you do the numbering and say we got around about, you know, 5 to 6% cases and 2% died, we would have had 50,000 deaths by my numbers. So that's nothing to you know, disregard. I mean, you know, we would have had 50,000 deaths if we had the same experience as what the US and Europe had done. So we can criticize all we like, but I mean, that's just the number that, and as you look there at the same time, GDP did decline last year, but by global standards, our economy actually did pretty well. You know, we've had our own V-shaped recovery. The unemployment rate has roared back into from over 7% to under 5%. So we managed to deal with COVID, whilst also, you know, the economy wasn't immune to a downturn, but by global standards, still wasn't all that bad. Just quickly on this, I mean, again, I crunched some numbers about the debate about AstraZeneca versus, you know, getting COVID. And as you can see here, let's take the typical, say, 55 to 60, sort of middle-aged groups. Basically, if you take all the numbers suggest there's basically a 1 in 1 million chance of dying if you take back the AstraZeneca vaccines. Okay, that's not zero. So, you know, 5 million take it. Unfortunately, you know, on average, it would suggest 5 people would die. But if you look at it, there's a 7,500 in 1 million chance of getting COVID. Of dying if you were to get COVID. So it's a lot higher risk of dying should you get COVID. Still low, but certainly a lot higher compared to having taken even the AstraZeneca vaccine. And so I've just done some numbers there of what is the probability of getting COVID to justify taking the risk from taking AstraZeneca. And bottom line there is you don't need a very high probability of catching COVID for it to make sense even if you can't get Pfizer, to take AstraZeneca. Now, to my, again, I won't dwell on this, but the big error in what we've done was the regulators basically, as soon as they said, people over a certain age can get Pfizer, but everyone else has got to get AstraZeneca, it destroyed the perception of AstraZeneca for everybody. Nobody wanted it as soon as they did that. And given these ratios and whatnot, it was probably again, part of that complacency. We felt we could wait for Pfizer, because we tackled it pretty well at that point, at least. That's all I want to say about COVID. I mean, that again, just in case you weren't aware of those numbers, I've crunched those numbers. So in terms of the outlook, look, the outlook is pretty good. We're still in a V-shaped recovery, as I said, with the vaccine rollout going well. You've got the unemployment rates have come down in many countries, particularly the US. And again, when we're thinking about financial markets, what matters most is the US economy. And as you can see, the unemployment rate has gone from over 12% back to the low 5% range at the moment. Still higher than what it was prior to COVID. So there's still some spare capacity in the economy. And that's why, incidentally, the Fed still believes inflation isn't going to break out on a sustained basis in the US, because ultimately the unemployment rate is still above full employment, and they don't see, and I don't see, a broad-based wages breakout. If you look at wages, they've had a spike higher in the US, but I think there's a lot of distortions in that due to COVID. They had a lot of hospitality workers lose their jobs, which initially pushed up wages. Because funnily enough, they're on below average earnings. So when they lose their jobs, it pushes up average hourly earnings. We are now seeing some wage gains in that area because there's shortages. Many people still haven't gone back to work for a variety of reasons. But broadly speaking, the thing to focus on is that the unemployment rate is still above full employment, and it's unlikely to see a sustained breakout in wage inflation, particularly in the US most importantly, but certainly not in areas like Europe or Japan either. So V-shaped recovery ongoing with still spare capacity in the economy, which is very important when you think about what central banks might do with interest rates. As long as they think there's spare capacity in the economy, the inflation risks aren't too high, they can keep interest rates on hold for a while longer, which in turn means that equity valuations, as I'll touch on later, can stay up a while longer as well. And just on that, this is you can see that the inflation spike, the core CPI is up over 4%. We actually got a reading overnight. It just ticked back down again. So I think we have seen the peak in this core inflation reading of the US, and that was driven by a lot of one-off, an isolated number of areas like used car prices going up, hotel rates going up, kind of quirky things. Used car prices went up because there's been a shortage of new cars. People are wanting to drive and not take public transport. So there's been a net increase in used car demand, which has pushed up used car prices, funnily enough. But if you look at other measures of underlying inflation, they haven't gone up anywhere near as much. And these are the sort of measures we look at in Australia. So the thing about the underlying inflation measure as widely used in the US, it strips out food and energy, but it doesn't strip out other things that may have untoward price increases in a month. Whereas if you look at things like the trim mean and the median, I won't get into the technicalities of it, but basically they strip out, they rank all the items within the CPI, and the most volatile items they strip out because they think that's an unrepresentative sample of what's going on in the broader economy. So if you do it that way, you basically have a distribution of increases across the economy, and you strip out the most volatile price increases and decreases, you get more a representative sample of what's going on more broadly. And on those measures, you can see, look, it has ticked up, but certainly nowhere near what the more traditional way of looking at underlying inflation in the US has done. And that's why, incidentally, the markets and the Fed have been able to look through that spike in inflation. You may be puzzled, why has inflation gone up so much? But central banks, markets are sort of shrugging. And in fact, bond yields over the last few months have come down, not gone up. And that's really the reason that they're looking through the fact that it's been bunched in a few areas, plus, as I mentioned earlier, that the unemployment rate is still, above full employment, gives them some pause to think, they're not going to get a sustained wage breakout in inflation. Australia also, up until recently, done very well. You can see the unemployment rate here had roared back in from over 7% down to 4.9%, would you believe? So, very, very strong rebound in our economy with the reopening that we were able to achieve, at least up until recently. Now, these numbers are going to change now. It's probably likely the unemployment rate over the next few months is going to bounce back up to the mid-5s. We're going to get some employment losses. Q3 GDP growth is going to be negative. And you can't rule out Q4 GDP, depending on how these lockdowns pan out. I mean, the thing about, you're going to get a big hit to growth in Q3. Now, if New South Wales stays in lockdown, growth is going to stay flat in Q4, but it may not fall any further. And as a result, you may not get a negative Q4 number. And as a result, you may not get what we call a technical recession, where you need 2 negative quarters of GDP. So we may get one incredibly negative Q3 number, but still a positive number in Q4, such that you might get headlines talking about, technical recession in the economy. Don't rule that out, because if the rest of the country had to go back into lockdown, I mean, Victoria's been in and out of lockdown, but if Queensland, South Australia, worst case scenario, you could actually still get a negative Q4 number. But anyway, the bottom line here is that the economy is going through it's a renewed slump, but the markets are looking through it, because as we learnt last year, is once we come out of the reopening, economic growth tends to bounce back pretty quickly. Consumers spend pretty quickly, businesses rehire pretty quickly, and so that would be the expectation. Just I'd touch on house prices. Always a lot of interest in this area. I'll just focus on this bottom slide here. This is mortgage affordability, how much the average household needs to devote to paying off a mortgage to buy the median priced home in Australia. And as you can see, it has declined over the last few years. It's actually at a relatively low level from long run average perspectives. And you can sort of see, or in fact, if you look at it here, it's basically back to its average, but it's well below the previous highs. And in areas like Sydney, similar. So, and in some other states, it's actually below average. So mortgage affordability, broadly speaking, is not that outrageous. It's actually only back to its long run average and below the peaks that we've been at. And in some cities, it's still relatively cheap. And that's because house prices broadly have gone sideways for many years. The RBA cut rates. And so it's improved affordability. So that's why house prices, with that V-shaped recovery and growth, are roaring. They're probably going to go through a pause now, of course, because of the lockdowns. But once we come out of that, I think there's probably more upside to come in house prices until we reach those affordability constraints, and all the Reserve Bank and APRA intervene with so-called macro-prudential controls, where they tighten up. They tell banks to tighten up on their lending. But at the moment, it's fundamentally driven. It's driven by very low interest rates and the V-shaped recovery in the economy. So I think they may let it go for some while. And also the RBA does want to encourage consumer spending. It does like the fact that high house prices create wealth effects and makes people more confident and spend. Now, you may not like the house price, boom that's generated, but it's actually part of the transmission mechanism from the RBA's point of view. And as I think it was notable a couple of weeks ago, last week, the RBA's meeting, the RBA is planning, it's buying bonds, as the Reserve Bank of the Federal Reserve is doing, and it planned to cut back its bond buying in September a month ago. It just had its meeting, and despite the lockdowns in New South Wales, at least at this stage, it's still planning to cut back on its bond buying at the September meeting. So very interesting that they didn't postpone that or even increase bond buying. And it shows you that the RBA, like the markets themselves, are looking through the lockdowns and thinking that growth probably should bounce back in Q4 as we come out of lockdown and the vaccine rates increase. Now, they may change their mind come the next meeting, but ultimately, RBA, whether they buy $1 billion more of bonds or less a week, doesn't really matter at the moment. It's all presentational being seen to be doing something, as I've explained. At the end of the day, they've already cut rates to zero. There's not much more they can do to support the economy, apart from trying to be seen to be doing something which indirectly, can bolster sentiment, at the margin, if people think that the RBA's, at least trying to do something to support the economy. But that's the situation in the RBA. They're on hold. I still don't see interest rates rising next year. And again, in terms of financial markets, we can debate whether they go in 23 or 24, but ultimately no one really knows, and it doesn't really matter in terms of market pricing today. It's so far out that it doesn't have a bearing, so I don't get into the debate, is it 23, 24, provided it's not 22, so that's the main thing. At this stage, for my money, I don't see them raising rates next year. Just moving right along, market outlook, and again, this is a very big picture point of view, is that this is the US unemployment rate, which is now, look, it's down to the low fives, but it's still above the prior low, and this is inverted. So if you look at these grey areas of US recession, so basically prior to the last few recessions, the unemployment rate got under 4%. So I think we're in a new expansion phase where equities generally outperform bonds. Until we get to late cycle indicators like a very low unemployment rate, the Fed having already tightened interest rates, profit margins. Anyway, there's a number of indicators that tell you whether you're early cycle, mid cycle, late cycle. At the moment, we're still early to mid cycle. So we're in this white patch where generally equities outperform bonds. This orange line is the ratio of equity market performance to bond market performance. Now, that's not to say you won't get pullbacks. You can get corrections in the market. Now, when we get closer to the Fed eventually raising interest rates, that may well be when you do get a pullback in the markets, because bond yields will go up. But again, it's not going to be a big bad bear market, provided the economy, doesn't tumble into recession. It's just one of these corrections that we tend to experience in the equity market. But importantly, these big bad bear markets, these that are drawdowns in the equity market, typically happen during US recessions. The good news, we had a recession last year. It was very short. We've come out of it, and the risks of one reappearing anytime soon is quite low. And that's basically what I call the 2-2 outlook. I do see core inflation in the US dropping back down to a 2% annualized pace. So the monthly numbers, if you annualize them, should be around about 2% in the second half of the year, which means that 10-year bond yields in the US can stay sub 2%, which I see as the line of the sand for the equity market. If they were to get above 2, then there'd be maybe more of a pullback in the equity market, would hurt valuations. And as I said, if that all pans out, the US market can continue to trade at a PE ratio, close to 20. It's around about 21 at the moment, but with a 2 handle on it. I won't go into. Just in the interest of time, I'll race forward. But basically, as you can see, equity. A lot of people focus on high PE valuations. As the point I've made, if you look at if you invert that PE ratio, you get the earnings yield, you take away the bond yield, you see the low end of the range since the GFC, which suggests maybe the market is a little bit pricey relative to bond yields, but it's still well above its longer run average level. So what I conclude about this is that the PE ratio is okay, provided bond yields, again, don't rise too far too fast. And for me, the line in the sand is 10-year bond yields at the US breaking above 2%. At the moment, they're 1.3. A few months ago, they were at 1.75. And again, at that time, I was saying I don't think they're going to break above 2. I think they're going to stay in a 1.5 to 1.75% range, because I don't see the Fed tightening within the next year. And bond yields have come back down since then. So broadly speaking, I think they're going to remain in a range. The earnings outlook is very strong. Again, I won't, in the interest of time, I won't go through this too quickly, but this orange line is what we call forward earnings. And the way these things work, it's going to touch this orange line, this blue line, wherever it is at the end of this year, and touch this green line, wherever it may be at the end of next year. And these are market expectations for earnings for each of these calendar financial years in the US. And so if you think 2022 earnings are going to be well above 21 earnings, calendar 21, where we are now, then this orange line can keep rising. So bottom line here is the market's expecting pretty solid growth in 21 and 22 earnings. And if that holds up, this orange line can rise another 14% between now and the end of next year, which is a nice tailwind for the US equity market. And if you look at it, the market analysts have been actually upgrading their numbers for through this year. And the Q2 earnings season that we've just gone through in the US was the strongest on record. Something like 80 to 90% of companies beating expectations versus a long run average of about 75%. So that could be even stronger. So that's the key driver of equity markets at the moment. So think about it from a big picture point of view. Interest rates broadly steady for now with central banks on hold. So valuations broadly steady, they staying broadly where they are, and earnings can continue to sort of help push markets higher. The only challenge for our market is that the earnings outlook, we've had an almighty, this is the Australian market, we've had a great rebound in earnings as well. So forward earnings, as you can see here, have powered on. So, you know, people saying it's all interest rates, it's the Reserve Banks. Earnings have rebounded very, very strongly on the back of the V-shaped recovery, both globally and in Australia. So this is a fundamental driver of the markets since late last year. Challenge for our market is at the moment, based on earnings expectations, there's not a lot more growth to come. And one of the things is that you look at where analysts are penciling in a big downgrade in resource sector earnings, which tend to be very volatile, but they think with a pullback in iron ore prices, that's going to hurt the resources sector. So our market, in an aggregate sense, is still somewhat more earnings challenged than global markets. Look, I'll just race ahead to some of the investment themes. What could go wrong? Delta, of course, if we get a new variant that is immune to the current vaccines. You know, never say never. But at the moment, at least, the vaccine is effective against the Delta variant. US inflation, again, I think that is a risk that is starting to moderate. China, look, again, you know, US-China tensions, both countries have got bigger issues to deal with at the moment, so I don't see a flare-up in tensions there at the moment. Both are focusing on, you know, dealing with COVID, and ultimately, as I've long argued in these, ultimately both countries will rattle the sabers, but won't do enough to derail growth in either of their economies. Ultimately, they don't want to jeopardize their economies. Investment themes. Look, I think ultimately we're going to see a re-emergence of the trend toward growth. So this is a chart of growth versus value globally. This is the US market. So the grey line there is the S&P 500. The orange line is the growth parts of the market. So companies and sectors with above average PE ratio, which is typically things like technology, consumer discretionary, so like the FANG stocks. The value parts of the market are things like financials and energy. And as you can see on this chart, really since the GFC, growth has been outperforming value. It had an extra kick along during COVID because the tech sector became a defensive sector. I mean, you've heard me say this in the past. For a long time, that had been justified by relative strength in earnings. And so the PE rate, the relative PE ratio of growth versus value hadn't gone up that much. More recently, it is starting to go up. So it's true that the growth is starting to get a little bit pricey relative to value, and it's something worth watching. So I'm not saying we're in a bubble yet. I actually think growth is going to continue to outperform value, and it may well be through earnings, but also through potential further PE escalation or valuation escalation, which could, you know, 2 or 3 years down the track, develop into a bubble. So just be on the lookout for that. But again, I don't think it's an issue at the moment. I think the FANG stocks, the tech stocks globally are going to remain, you know, very, very strong, very well supported. Just on Asia, I did touch, again, this is a blog if you're interested in this area. Hang on, I'll just get my mouse working properly. There it is. If you're interested in this area, the one area of the global technology sector that has had a pullback in the past few months has been in Asia, funnily enough, even though it's had the earnings outlook in Asia is still very, very strong. and a number of factors. But in particular, well, you've had computer chip shortages that have disrupted supply and production for some of the major companies like Samsung and Taiwan Semiconductors, which are Korean and Taiwanese companies, which are a big part of the Asian index. So our Asia Technology ETF. But also there's some of the Chinese companies, there's been regulatory risk emerged because China have clamped down in a few areas and imposed some new restrictions. But ultimately, I don't think it's derailing the long-term growth outlook for technology companies in Asia. Still very, and again, a bit like the US-China trade wars, China will do stuff, but ultimately won't disrupt the business models of these companies because they're very important to the Chinese economy and for China itself to continue to move up the technology curve and become a modern economy, less reliant on cheap manufactured exports to the rest of the world, and less reliant on infrastructure spending in its own economy. So the bottom line of that pullback is that the PE ratio for Asia relative to global technology has got relatively cheap. It's at around a 30% discount. Long run average is about 15% discount. And the forward earnings outlook, the earnings outlook for Asia is still very, very strong. So we'll see what happens in China going forward. But again, ultimately, I don't think they are going to, continue down this case of, really tearing apart these companies. It's not in China's interest ultimately to do that. So the other one, so again, just to reiterate, in terms of technology exposures, that we have, that you may or may not know about, many of you probably do, is the NASDAQ ETF, of course, which tracks those big FANG stocks amongst others in the US. That's continuing to do pretty well. Again, I think as the dust settles on COVID, they're going to probably continue to reassert their relative strength. We do have a number of other areas in the technology area, like Asia technology, also cybersecurity, cloud computing. Earth is another one, which is a decarbonisation ETF. Get a benefit from the massive increase in activity to decarbonise the world. And we just had the IPCC report only a few days ago underlying the urgency to deal with climate change because of global warming. So we have a number of technology and growth exposures. Now, one that I just wanted to highlight also is global quality. So this is an ETF that tracks global companies with above average return on equity. It does have some tech exposures, but it has some things like credit card providers as well, and some blue chip consumer companies that just very strong companies. And as you can see here, the relative performance, it's actually been a trend outperformance. It had a period of underperformance when the value parts of the market roared back with the recovery from COVID, but it's starting to potentially reassert its outperformance there. So if you want something a little bit less techy but still pretty solid, that's another type of exposure globally you might want to think about. Now, I might just leave it at that because we've run out of time, and there's a few other slides, but I will close it there.
Excellent. Well, thank you, David, and thank you for covering some of those really key areas, which I'm sure a lot of our people on the webinar today were looking to get some color on. And look, we've had a lot of questions come through, and thankfully a lot of the things that they are asking you've covered, so that's always a plus. But look, just to kick off, and before we go into that Q&A side, just things to consider as always. There are investment risks in terms of market risk with equities, currency risk, and international investments. There's no guarantees, as noted before. Future outcomes are uncertain. General advice, again, just noting that we haven't taken into account anyone's personal circumstances today. And if you do need that extra level of guidance and advice, please do see a professional around that. And in terms of the support, there's always, as mentioned earlier as well, there's PDSs, fact sheets can be all found on our website. So look, conscious of time, and as I mentioned, there was a lot of questions, but to kick that off, David, just to start, there's a question here saying, does David see there being a chance of a 10% correction at the moment, given, I guess, the high valuations, where the 10-year bond yield is at? China and their crackdown on companies and the tensions between the USA and China, and also COVID to put on top of that. So can you answer that one there, Dave, mate?
Look, in terms of the risk, I don't see a strong case for a 10% correction anytime soon. Again, I think Delta was potentially a risk, but the vaccines, I think, are dealing with that globally. The other risk is, I didn't mention Fed tapering. I mean, the other risk to bonds is, the Fed are inching closer to reducing their bond buying. They're not looking to raise interest rates, but as you may know, at the moment, the Federal Reserve in the US is buying $120 billion worth of government and corporate bonds every month. And now as the economy's roaring back, they don't need to do that anymore. So they're inching toward telling the market we're going to start reducing our bond buying. But I think when that announcement comes, it's going to be well telegraphed, and the actual reduction in bond buying will be very gradual. So I don't anticipate that having a big impact on bond markets. In fact, the Fed's own modelling suggests it's about a 25 basis point affect their bond buying in and of itself. So if they were to stop overnight, go from 120 to 0, the modelling at least suggests bond yields go from 1.3 to 1.55 or something like that. But again, my line in the sand is say 2. I mean, no one really knows, but I think there comes a point where the bond yields go too far too fast. It will have an impact on the markets, but provided it stays in this range, I think it won't have an impact. So again, I don't see tapering as causing certainly a 10% pullback. It may cause a 3 to 5% pullback. I mean, the biggest risk ultimately to the markets is when we do get closer to Fed tightening. Typically, historically, when the Fed does go through a tightening cycle, when it starts raising interest rates, markets have had a correction. But again, at the moment, that's not looking like it's 2022. It could be 2023, and then that's when markets will be vulnerable to a valuation correction back. Look, never say never, but in terms of the risks that I foresee at the moment, I don't see them bubbling up to significantly affect the markets.
Excellent, thank you for that. And I guess with that, there has been a few questions around, well, you mentioned that the RBA have indicated that they are going to be reducing their bond buying, but with that looking both domestically and globally, how long can these, federal or the RBA actually stimulate the economy through this type of support through COVID? Do you have a view on that?
The RBA can buy more bonds. It's actually, by global standards, not buying that much. But ultimately, I don't think bond buying has all that direct effect on the market. At the margin, it makes long-term bond yields a little bit lower in Australia than they would otherwise be. But the lending rates in Australia are actually more priced off shorter-term interest rates. It does affect like long-term bond, the rate that corporates can borrow at a longer term. But the RBA's estimate suggests their bond buying is about 25 basis points. So were they not doing anything, bonds would be, instead of companies borrowing at say 3%, they'd be borrowing at 3.25% or something like that. In large part, this bond buying is present. I don't want to deride it too much, but I think it's it's a presentational thing about being seen to be doing something when you've already cut the cash rate to 0 and you don't want to cut it to negative because that's not going to be all that helpful. So it's almost a way of trying to support business and consumer confidence once you've basically fired all your bullets and you've got no more bullets left in the gun.
Cheers. Thanks for covering that. Another really good question here is what are some of your favorite late cycle indicators that you look at?
Yes, first and foremost, the US unemployment rate. So if that were to get to sub 4, and hit the last that in and of itself doesn't cause recessions per se, unless you get a wages breakout and then the Fed. But it basically makes the economy more vulnerable because there's it's a more hot economy. So unemployment at below 4%, and we could get there. Within the way the economy is roaring at the moment, we could get to sub 4%. Within 6 months, if not a year. So that's a late cycle indicator. But other ones are like the Fed tightening interest rates and the yield curve going negative. which basically indicates that monetary conditions become tighter. Other things are like the US profit margins. They've been expanding, but again, if you look at historically, profit margins tend to peak maybe a couple of years before recessions. Again, it's not a recession indicator per se, but it does suggest you're getting toward the later stages of a cycle rather than the earlier stages. So there's a number of those sort of indicators that I look at, and then there's obviously, you know, actual economic indicators, things like jobless claims that give you real-time information on the economy. But by the time you're looking at them, that's pretty late in the day. But yeah, so there are a few, and again, my judgment at the moment is we're still maybe not early cycle, we're probably mid-cycle now, given the unemployment rate. You know, how far the economy in the US has rebounded so quickly. It's probably fair to say we're mid-cycle now rather than early cycle, but certainly still not late cycle.
Excellent, thank you for that. And I guess looking at the Australian market and some of the risks there's been some questions around, you know, are we in a commodity super cycle, and what's your view, I guess, on the broader Australian market in terms of, you know, some key factors? Will commodities sell off, and will that have a meaningful effect in terms of iron ore?
Yeah, I don't think, and again, I think I've shared with this in the, I mean, there was a debate earlier this year, you know, that maybe we're on the new commodity super cycle because of the demand for minerals for, you know, batteries and building, you know, renewable energy, solar energy, these sort of things. And the other debate, you know, other argument is that maybe we're in this ongoing low inflationary tech disruptive type world where growth, you know, technology outperforms mining and commodity producers. And I'm still in that camp that it's a technology low inflationary, despite the spike we've had in the short run in the US, rather than a renewed commodity boom. And again, historically, major super cycles in commodities, if you like, have required major parts of the global economy to industrialize. It's a demand-led thing. So we've had, you know, US 100 odd years ago, Japan and Germany after World War II, and China most notably from, you know, from the late 80s, and particularly when it joined the WTO. There's no, you know, next cab off the rank, so to speak, to go up that industrialization path. So I don't think clean energy demand is enough to cause a commodity super cycle. But you know, some areas maybe, you know, this is maybe where stock pickers and can have a role, because there's certainly some minerals like you know, lithium, nickel, copper, cobalt, for example, that are figure in battery technology and solar technology that may see relatively strong demand compared to other things. But broadly speaking, I don't think we're on the cusp of a new commodity cycle, and that ultimately does mean that I think our market, you know, as I said earlier, is going to be earnings constrained. Typically, when it's a growth technology type environment, you know, which is outperforming, our market tends to, you know, it can still go up, but it won't go up as much generally as global markets will do. So that's why, you know, I think from a market perspective, our market will tend to underperform global markets over, say, you know, a 2 to 3 year view here.
Okay, thank you for that. Another sort of, there's been a few questions, I guess, and it probably fits very nicely in terms of your view of our sort of domestic commodity sector, is your view on the Australian versus US dollar. What's your sort of forward-looking view on that?
Yeah, I didn't get a chance to mention in the webinar, but I had a view. I mean, again, if you listen to earlier webinars, I did have a view that because we aren't in a commodity cycle, I was not seeing when the Aussie was up around 78, 79 cents, I basically had a view, I don't see it pushing up through 80 cents, because I think iron ore prices are you know, at $200 a ton. I don't think they can go much higher. They did go a little bit higher, but now they've since come back. And I had actually Aussie coming back down to 73 cents, which is where we are now. So, and that's because iron ore prices have started to come back. China have tightened. They've been trying to rein in their steel producers. A lot of regional steel producers, they're producing too much steel, more than they need. trying to export that excess globally, but basically they're trying to rein in steel production. But more importantly at the moment, as the Fed goes closer to tapering, and we, because of our lockdowns, are still going to be, in a weak environment, I think the Aussie, if I had to say, if at 73-ish cents today, is it going to go higher or go lower? I think it's probably going to go lower. So I actually, think it may well test 70, potentially even 68 cents over the next few months if the Fed does move ahead with tapering and we're stuck in lockdowns and weak economic growth and iron ore prices continue to pull back.
Fantastic. And you did note, I guess, that new fund we have in terms of our climate change and innovation ETF, in terms of that decarbonisation exposure. There has been a number of questions around that recent IPCC report, and looking at that in terms of, what is the economic effect on that on markets? I guess that report, combined with a lot of the climate change catastrophes that are happening, the fires in Greece, what we had here in Australia only a couple of years ago, the flooding in Europe and Canada. So what effects is that going to have on the market?
Well, I mean, what we do know is the private sector is, through consumer demand and a lot of the activity at the moment is being driven by the private sector, going ahead of government. So, up before Biden, of course, we had Trump, who was sort of dragging the chain on climate change. China, they've been doing their part, but probably still dragging the chain somewhat, of course, in Australia. So governments have been lagging here, and this is why the IPC have come out. We haven't really tackled this all that well, and the urgency. Again, I know this is a hot topic with some people, but I'll state my case. I think Rudd said it a few years ago, but then did nothing about it. But it is a massive potential catastrophe. I mean, I can't underestimate how serious this is to the global out, and I just really have so much anguish for my children and grandchildren and our grand-grandchildren as to how we're going to deal with this. Hopefully, technology may save us ultimately, but in a 3-degree world, I mean. But even a 1.5-degree world is going to lead to major, changes. So look, I'm going off track here, but I mean, basically, this ETF that we've designed is a decarbonisation. We know there's going to be so much activity to decarbonise the world. Governments are going to slowly but surely get on board here, and there's so much private activity. And this fund, and what we've done. You can go and buy a battery, ETF or buy a clean energy ETF. Now, we've basically come up with a very diversified exposure, because if you look at the IPC reports and all the experts say, just clean energy, renewable energy is not enough. We need to change the way we make buildings, change the way we grow food. We need to do a lot of things. And so there's going to be a lot of demand across a lot of areas. And investing in like solar technology or it may be great, but there's some technological risk in terms of what will be the winning technology going forward. So definitely go down that path if you want. But the idea of Earth is to give you a broad, diversified exposure to a whole range of activities that we know are only going to ramp up in demand over the next few years. And the beauty also of that ETF, it's a market cap index. So if companies are doing well and their market cap rises, the weight of those companies in the index will go up. Similarly, if companies, whatever they're doing doesn't quite hit the mark and their market cap falls, the way in which the indices are rebalanced, they will actually fall and drop out of the index. So although it's a passive exposure, and it's actually not a bad strategy in such a very dynamic area as this. It will ensure you're still investing in the winners in this area and gradually divesting the losers in this area.
Fantastic. Thank you so much for covering that. And look, I think we've got time for one more question. Look, this is just in relation to you mentioned in the presentation that the recovery, and I guess some of the PEs, both domestically and globally, have been held up by the earnings of these companies. Now, I guess the question here is how sustainable are those earnings of those companies? And could a drop in those earnings have a near-term impact on the markets?
Yes, they could. And again, as I showed earlier, the outlook at the moment for earnings expectations globally is still very, very strong. So in the US, it's something like, based on current expectations, 15%. So I look at a measure called forward earnings, and that's it's a rolling measure of, it's a weighted average of earnings expected for the current financial year and next financial year. So it's a sort of forward-looking measure. And as we roll forward, it basically adds a higher and higher weight to expected earnings for the following few years. So it's a forward-looking measure of earnings, and that again. So the beauty of looking at that, and when you talk about things like a price to forward earnings ratio, like market valuation, that's the price of the market vis-a-vis current level of forward earnings. And so if forward earnings rise and the PE ratio stays where it is, it can still drag the market up. And so that's the sort of outlook I still see at the moment. But yes, of course, mathematically, if earnings fall, then PE ratio, either the market then falls in line with earnings, or the PE ratio will go up. The PE ratio is already elevated, so maybe it's not going to do that. But at the moment, I think the outlook for earnings is still pretty good for the reasons I outlined before. The challenge is that in our market, the overall market earnings are not as strong as they are globally. But at the moment, that's because of the analysts expect a big drop in resource sector earnings on the back of a chunky decline in iron ore prices. Now, in other sectors of the market, banking in Australia is good, but again, we're talking, single-digit earnings growth versus, double-digit earnings growth of some of the global tech areas. So that's a problem for our market also. Big chunk of our market are very mature, slow-growing companies on the one hand, the banks, and on the other hand, the miners, which have very volatile earnings. So they can have a year of very strong earnings and then a year of very weak earnings. So overall, our market is challenged from an earnings point of view, but there are definitely sectors like, again, our ATech ETF. If you want the technology sleeve of our market, you can get that through that ETF. So I guess in our market, it's more of a question of, well, it's always the case, if you want to go down that path, picking sectors, or if you want to go even further down that path, picking individual companies. But it's a very hard to do that correctly. All I would say is that the earnings outlook globally, sorry, just to conclude, is actually at the moment still pretty good. So I can still see that pushing up the markets, but our market going up as well, but not as much.
Excellent. Thank you, David, and thanks again for taking the time to give us some insight around where both domestically and globally markets are, some of those key risks, and again, where investors can potentially use ETFs to invest in their view within their portfolio. So thank you so much, and thank you everyone for attending today. We really do appreciate it. Thank you for all those questions that came through. And again, if you need any additional information, please do visit our website. There is a heap of information on there, and again, you can keep across all the new funds and the upcoming webinars as well. And as mentioned, this webinar will be sent out at the conclusion of today. So thank you. Have a good Thursday, and we look forward to speaking to everyone soon. Thanks.
Bye for now.